So financial reporting. Chapter 15, IAS 37 we discussed in previous class. Provision, contingent liability, contingent asset. One small standard, IAS 10 left. IAS 10, events after reporting period. Events after reporting period. What does that mean? Suppose this is our year end. That suppose started on 1st of January 2023 and ended on 31st of December 2023. After this, there will be next year that will end on 31st December 2024. What happens? At every year end, company need to prepare their financial statements. Means at this date, company will prepare financial statements. But normally company issue financial statements after 3 to 4 months of year end. Because company issue financial statements at AGM. So normally AGM they conduct after 3 to 4 months of year end. Mean here they will issue financial statement. Before issue of financial statements, director need to sign, mean approve of financial statements for issue. Who is responsible for preparation of financial statements? Management mean directors. So before issue, they need to sign the financial statements. Sign means they will own the financial statements. Like if there is any issue, who is the main owner of financial statements? Directors. So before issue, director need to approve financial statements for issue. So this is the date where director approve financial statements for issue. This period from year end till director approve financial statements for issue. This period is called post year end period. Or it is also called periods after reporting date. Periods after reporting date mean year end date till the date director approve financial statements for issue is called post year end period or period after reporting date. For this period, there are some responsibilities of directors relating to financial statements for IAS10. What are their responsibilities? If any event happened between this period, if any event happened between this period, director need to identify whether that event is a adjusting event or non-adjusting event. Mean events occurring between year end date, mean financial statement date, and date director approved financial statements for issue. Those events will be either adjusting or non-adjusting. What is event? So in this period, company acquire any other company acquire any non-current asset. In this period, some of the inventory destroyed due to flood or fire. In this period, company aware about bad debts, mean customer become insolvent. In this period, might be there was a past court case, and in this period, it was decided against the company. Mean company need to pay the damages. So these are called events. So in this period, post year end period, director need to identify adjusting events and non-adjusting events. For adjusting events, they need to adjust the financial statement. Mean they need to add or subtract any figure in the financial statement. They need to change any account balance in the financial statement. Either they need to create any account balance, either they need to add any account balance, either they need to subtract any account balance. And for non-adjusting events, they need to provide a disclosure in financial statement. Only if non-adjusting events are significant. Significant means material, important, big event, having impact on the financial statement. What are adjusting events? What are non-adjusting events? We're gonna discuss later on. So where director need to identify adjusting, non-adjusting events, year end date till the date financial statements approved by the directors. Any event occurring after approval of financial statements will be neither adjusting nor non-adjusting. Adjusting, non-adjusting events are those events that are happening in this time period, mean year end till financial statements approved for issue. Adjusting events need to adjust, non-adjusting events provide disclosure in the financial statement. This is the accounting treatment of adjusting, non-adjusting. What are adjusting events? What are non-adjusting events? Let's discuss with their examples. So events after the reporting period are those events both favorable and unfavorable. Could be beneficial for the company, could be unfavorable, mean creating cost, loss for the business, which occurs between the reporting date, mean year end date, and the date on which the financial statements are approved for issue by the board of directors. Adjusting events are events after the reporting date that provide additional evidence of condition existing at the reporting date. Mean the events about which any condition exists at the reporting date. What does that mean? The events about which any account balance in the financial statements that need to be changed, that require to be changed, will be called adjusting. There is a receivable written in the financial statements balance sheet under current asset. After year end, you are aware that a receivable become bad. Mean company will not be able to recover the amounts from the customer. Is that receivable written in the balance sheet is a receivable now? No. So we need to create bad debts, mean irrecoverable debt, because this is adjusting. Because this is relating to a receivable written in the financial statement. Is a fine. In company, normally we record inventory at lower of cost and NRVs. NRV mean selling price less cost to sell. This means in NRV, cost plus profit part included. And for normal inventory, always cost is lower than NRV. So we record inventory on cost normally because cost is lower than NRV. So we recorded inventory on cost basis because cost was lower at year end. So inventory is recorded on cost basis. But after year end, when company is going to sell the inventory, they see they are not able to sell the inventory of cost. In fact, 10% lower than cost, they can sell the inventory. Might be that inventory become out of fashion, out of season, obsolete. Which means after year end, we are aware the inventory recorded at the financial statements on cost is overstated. Why? Their NRV is lower than cost. This is called adjusting event, mean we need to adjust the inventory, mean we need to record the inventory on NRV. And the difference between cost and NRV will be recorded as loss. What are non-adjusting events? Are events against which no condition exists at the balance sheet date, year-end date. What are these? Destruction of assets by flood or fire. Mean after year end, in year end is 31st December, in February, there was any flood or fire. Due to that, any of the asset destroyed. If that asset destroyed, company has suffered the loss. That loss is relating to next mean 2024 year. That loss will be reflected in 2024 financial statements. Because there is no condition exist at 2023. But as we have aware about this loss before issuing the current year financial statements in 2023 financial statements, so we need to provide a disclosure in current financial statements. Just to provide information to the shareholder, like this loss will be reflected in the next year financial statement, so that they want to make any decision, they can. Just for the help of shareholder. This is called non-adjusting events requiring disclosure in the financial statement. Can you understand what is adjusting? What is non-adjusting? There are some examples of adjusting events. Irrecoverable debt arising after the reporting date, which may help to quantify the allowance for receivable at the reporting date, mean bad debts, confirmed bad debts, against which the receivable is recorded in the financial statement. So we need to adjust the receivable, mean we need to record irrecoverable debt. Sale of inventory below cost, providing evidence of NRV, mean low NRV. Amounts received are receivable in respect of insurance claim, which were being negotiated at the reporting date. Mean after year end, there was a loss of a company. Company recorded the loss, but after year end, company received the amount from the insurance company. This means company need to omit that loss from the financial statements because that loss is not bear by the company, it's recovered by the insurance company. The discovery of a fraud or error. After year end, we identified there is any misstatement in the financial statements due to any fraud by the management or employees, mean any figure is overstated or understated, or due to error, any figure is over or understated. Before this company issue wrong financial statement, they need to. This is also called adjusting. Mean misstatement found in financial statements. Obviously, you need to correct those misstatements before issue the financial statement. This is adjusting. Figures are wrong in the financial statements that you need to rectify. One example could be relating to impairment. You have recorded an asset in the balance sheet at year end. Immediately after the year end, you are aware its market value is lower than what you have recorded as carrying value. This means the impairment loss was not recorded that you need to record. For that, financial statement need to be adjusted. One example could be relating to provision. There was a court case before year end. After year end court case decided company need to pay the penalty. This means provision should be there in the financial statement. What are non-adjusting events examples? A major business combination after the reporting date, mean you acquired or purchased any asset, significant asset, or any subsidiary. Obviously, if after year end any subsidiary acquired, next year financial statements will be consolidated financial statement. But as the decision has been made or this acquisition has been made before issue of current year financial statements, so we need to provide a disclosure for the shareholder. for their better decision making, next year financial statements will be consolidated financial statements. A destruction of major production plant by fire or flood, mean destruction of any asset after year end by fire or flood. So this loss will be reflected in next year financial statements. But as we are aware about it before issue of current year financial statements, so we need to provide a disclosure. Abnormally large changes in asset prices of a foreign exchange rate after the reporting date. Mean due to foreign exchange rate, if there is a changes in prices of any asset that will affect our future business, so we need to provide a disclosure. So adjusting events we need to adjust, non-adjusting events we need to disclose. Test your understanding 2. Anderson year end is 31st December 20x1 reporting date. The following events all occurred in January 20x8, mean after year end. State whether the events below would be classed as adjusting or non-adjusting. Insolvency of a customer. Loss of inventory due to flood. Completion of the purchase of another company. Evidence showing that the net realizable value of inventory is below cost. A court case from August, mean before year end, is settled by Anderson. The discovery of a fraud. Shortly after the reporting date, a major credit customer of an entity went into liquidation, mean become insolvent. Because of the heavy trading losses, and it is expected that little or none of the 12,500 debt will be recovered. So adjusting event. 10,000 of the debt relates to sales made prior to the year end, and 2,500 relates to sales made in the first 2 days of the next financial year. This means at year end, 10,000 receivables recorded from this customer. Remaining 2,500 is receivables relating to next year. So for 10,000, we need to adjust the receivable. For remaining 2,500, irrecoverable debt, mean bad debts will be recorded in the next year. In the 20x1 financial statements, the whole debt has been written off. Is that right or wrong treatment? Wrong. But one of the directors has pointed out that as an liquidation in an event after the reporting date, the debt should not in fact be written off, but disclosure should be made by note to this year financial statement. And the debt written off in the 20x2 mean next financial statements. Advise whether the director is correct? No. Because if customer become insolvent, there's evidence that condition exists at the year end. Because there is a receivable of 10,000 at the year end that will not be recovered. So for 10,000, there should be adjustment in the 20x1 financial statements. 2,500 is a receivable of next year. So that will be adjusted in next year. And if it is significant, for that, there should be disclosure in the financial statement. Dividend. Post dividend. Is that adjusting event or non-adjusting event? Suppose me, director, company propose like we will pay dividend to the shareholder by this amount. If it is not approved by the management, we should not record in the financial statement. If it is approved, then it is adjusting, we need to record in the financial statement. So equity dividend proposed before but approved and paid after the reporting date may not be included as a liability at the reporting date. We account for dividend on cash basis, so they are non-adjusting event after the reporting date and must be disclosed by note if it is approved. If it is not approved, there shouldn't be even any disclosure. Test your understanding 3. Rendell is currently preparing its financial statements for the year ending 31st March 20x8. The board has met to discuss the following issues. You need to do. Explain how these matters should be dealt with the financial statements of Rendell in the year ended 31st March 20x8. And there are two separate issues. Issue 1. Some of products sold by Rendell are sold with warranties, enabling customers to return faulty goods within 2 years of purchase. Rendell will either repair the product or refund the sales value to the customer. During the year, the sale value of products sold with such warranties total 300,000. And this is a total sale against which company providing 2 years warranty. Based on the past experience, it is anticipated that 20% of these products will be returned under the term of warranty. This means 20% of this 60,000 company need to create warranty provision. Of the goods that are returned, it is expected that 5% will beyond repair and Rendell will need to refund the full sales value to the customer. 5%, there is no repair expense, there is no expenditure. You need to give them full amount. 12,000. 60,000. What is 5% of 60,000? What is 5% of 60,000? 3,000. So for 3,000, the customer will claim money. The remaining 95% of returned goods will be able to be repaired. This will cost Rendell on average 30% of the item's sales price. In for remaining 90%, you need to make a repair. And repairing cost is 30% of the item's sales price. This means out of 60,000, 3,000 provision should be created. What about remaining 57,000? Out of this, only with the 30% you need to create a provision. Because your expenditure will be what? Repair expense. How much? 30% of this 57,000. 17,000. 17,100. 17,100. Some of the goods that have been sold this year have already been returned under the term of the warranty. Rental has incurred cost of 5,000 in respect of these items. This means 5,000 they have already incurred the cost. This means if we deduct 5,000, 12,100 plus 3,000, 14,100 they need to create provision because of 5,000 already utilized. 15,100 they need to create provision because for 5,000 already provision provided. As at 31st March 2007, Rendell's financial statement showed a provision of 14,000 in respect of warranty cost. This was made up of 4,000 in relation to goods sold during the year ended 31st March 20x6 and 10,000 in respect of goods sold during the year ended 31st March 20x7. Mean they created provision of 14,000. Out of this, 4,000 is relating to previous year because they are providing warranty for 2 years. And for current year, they have created provision for 10,000. How much provision for current year is required? 15,100. This means they need to create more provision by how much? 5,001 for the current year. The warranty in respect of these items sold during the year ended 31st March 2026 has expired as 31st March 2028. Obviously, you are providing warranty for 2 years. So in 20x8 financial statements, that 4,000 provision should be eliminated because their warranty expires. So there will be no claim against that 4,000. During the year ended 31st March 20x8, 3,000 of cost were incurred in respect of warranty claim made in relation to goods sold in the year ended 31st March 20x7. What was the requirement? Explain how these matters should be dealt with the financial statements of Randall in the year ended 31st March 20x8. So relating to 20x7, what was complete provision? 15,100. Out of this, 10,000 was already there. So remaining 5,100, they need to create more for 20x7. Is that? But they created how much? 14,000. This means at 20x7, they need to create more 5,100. So that it should become total 15,100 for 20x7. 20x8 start. At 20x8 start, they will be having provision balance 4,000 plus 15,100 mean 19,100. Out of this 4,000 is eliminated, remaining what? 15,100. Out of this 15,100, they provided warranty of 3,000. This means remaining 12,100 for 20x7. And for 20x8, they need to create provision. How much? 7,100. Mean at end of 20x8, the provision should be this much. For 20x7 and 20x8 sales. This we need to discuss. Part 2. A month before the year end. Month before year end. A fire destroyed a significant proportion of Randall's inventories. Randall has since been negotiating compensation with their insurers. Initially, the insurers were of the view that Randall had not followed applicable legislation to protect against fire damage and were contesting the claim. Randall was confident that they had complied with the legislation and referred the matter to their solicitors. Mean we need insurance claim. In April 20x8, after year end, the board of directors received a letter from the insurance company stating that they are satisfied that Randall did comply with appropriate legislation. The solicitors have advised the directors that it is now probable that they will receive compensation in the region of 50,000. So as it is probable, they need to disclose what? Contingent asset. That's your understanding for State the accounting treatment for each of 4 cases. Good luck, everybody. Continuing liability. So S company is currently involved in 4 legal cases, all of them unrelated, means separate cases. In case A, S company is sued a supplier for 100,000. Supplier have filed a case against the company. S company have been advised by its lawyer that the probability of success in each case are as follows. Likelihood of S company winning the case. In A, 10%. Company have sued the supplier or supplier have sued the company? Company has sued the supplier for damages claim. 10% possible of inflow. What we should do? Ignore, do nothing. In case B, S company is suing a professional advisor for 200,000. And there are 90% chances that company will win the case. Contingent asset because probable. In case C, S company is being sued by a customer for 300,000. 98% chance S company will win the case. There is 2% chance of economic outflow. 98% chance is not for outflow. What is chance for economic outflow? Only 2%. Remote. Less than 5%. Made the mistake. In case DES company is being sued by an investor for 400,000, 60% chance company will win the case, 40% company need to pay the amount. So there is possibility. So contingent liability disclosure should be there. See, customer have sued the company for damages 300,000. Mean there is chance of outflow. Likelihood of S company winning the case. 98% chance company will win the case, only 2% chance company will lose, mean need to pay the customer. Yes. Probability of future economic outflow. How much? Is 2%. That is a report. Test your understanding 5. Option A, B, C, D. Option A, B, C, D, please. Quick, 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 so that we can move towards next chapter. Jackson Company year end is 31st December 20x0. In February 20x1, a major customer went into liquidation, become bad, and the directors believe that they will not be able to recover the 450 adjusting event. So how should this item be treated in the financial statements of Jackson Company for the year ended 31st December? The 450 should be disclosed by note. No, this is adjusting. The financial statements are not affected at all. No, they are affected. The financial statements for 20x0 are not affected, but the balance should be written off in 20x1. No, the financial statement should be adjusted to show irrecoverable debt. Number 2. A farmer employee is claiming compensation of 50,000 from Harriet for wrongful dismissal. The company solicitor have stated that they believe that the claim is unlikely to succeed. Likely probability, unlikely possibilities. The legal costs relating to the claim are likely to be in the region of 5,000 and will be incurred regardless of whether or not the claim is successful. Provision should be made for 55,000. No. For 50,000, there is possibility. Provision should be made for 50,000. No. Provision should be made for 5,000. These are the costs that you need to bear to pay the solicitor. And the compensation of 50,000 should be disclosed by note. Yes, contingent liability. No provision should be made, but both items should be disclosed by note. No, 5,000 you need to pay to defend the case. Number 3. Blacksmith has claimed compensation of 30,000 from another entity for breach of copyright. Inflow. The solicitor of Blacksmith have advised the director that their claim is likely to succeed. Probability. So should this item be treated in the financial statements of Blacksmith? The item should not be included in the financial statement. The item should be disclosed by note in the financial statements. By note mean as a contingent asset. Likely mean probability. The financial statement should show an asset. No. The financial statement should show an asset of 30,000. No. Contingent asset only. Number 4. Events after the reporting date, which of the following item are non-adjusting item as per IAS10, non-adjusting items. Changes in the rates of foreign exchange after year end, non-adjusting. Destruction of machinery by fire, non-adjusting. Net realizable value of inventory being lower than cost, this is adjusting. Acquisition of compactor business mean subsidiary, this is non-adjusting. Insolvency of a customer, that is adjusting. So 1, 2, and 4. Which two of the following could be classified as adjusting events occurring after the end of the reporting period for the year ended 31st December 20x1? We need to identify two adjusting events. A serious fire occurring 1 month after the year end that damaged, no, this is non-adjusting. 1 month after the year end, a notification was received advising that a large receivable balance would not be paid, adjusting bad debts. A large quantity of parts for a discontinued production line was discovered at the back of the warehouse during the year-end inventory count on 30th December. The parts have no value except a normal scrap value and need to be written off. A large quantity of parts for a discontinued production line was discovered at the back of the warehouse during the year-end inventory count. Year-end is 31st December. So this is not happening between post-year-end period. We need to find adjusting, non-adjusting events in post-year-end period. The entity took delivery of a new machine from the USA in the last week of the financial year. It was discovered almost immediately afterwards that the entity supplying the machine had filed for bankruptcy and would not be able to honor the warranties and repair contracts on the new machine. Because the machine was so advanced, it was unlikely that any local entity would provide maintenance cover. Did that even happen between year end date and actor approved financial statements for issue? No, they received when? Before year. An asset held for sale was held in current asset at 70,000 in the financial statement. Discontinued operation asset held for sale that we need to reclassify, but was sold for 65,000 after the year end. So we need to classify the asset at fair value. After year end, it is going to sell at 65,000. This means this is adjusting event. We need to record asset at fair value. PL. Number 6. X is currently defending two legal claims. An employee who suffered severe acid burns as a result of an accident in X factory is suing for 20,000, claiming that the directors failed to provide adequate safety equipment. X lawyer are contesting the claim, but have advised the directors that they will probably lose. Probability of payment provision. A customer is suing for 550,000, claiming that X hair care product damaged her hair. X lawyer are contesting this claim and have advised that the claim is unlikely to succeed. Contingent liability. How much should X provide for these legal claim in its financial statement? How much? 20,000 per year. Because this is contingent liability, this is provision. In the financial statements, how much they need to record 20,000. Number 7. Which of the following should require a liability to be created by BW at the end of its reporting period? The government introduced new laws on data protection, which comes into force on 1st January 20X2, in after the year end. BW's directors have agreed that this will require a large number of staff to be retrained. At 31st December 20X1, the directors were waiting on a report they had commissioned that would identify the actual training requirement. And government announced the new laws after the year end. Whether in financial statements liability should be created? No. Disclosure. At the end of the reporting period, BW is negotiating with its insurance providers about the amount of an insurance claim that it had filed. On 20th November 20X1, the insurance provider agreed to pay 200,000. This is not liability. This is inflow. BMW makes a refund to customer for any goods returned within 30 days of sales and has done for so many years. Provision should be recorded. Warranty provision. A customer is suing BW for damages alleged to have been caused by BMW products. BW is contesting the claim, and at 31st October 20X1, mean year end, the director have been advised by BW's legal advisor that it is unlikely to lose the case. Mean possibility, we need to make payment. Mean contingent liability. So where liability should be recorded, provision liability under C. Number 8. DHA has the following 2 legal claims outstanding. A legal action, what we need to do? How should DH report these legal action in the financial statements for the year ended 30th April 20X1? Mean for which provision, for which nothing are disclosure. Okay. A legal action against DH claiming compensation of 700,000 filed in February 20X1 before year end. DH has been advised that it is probable that it will lose the case, mean they need to make the payment. So this is forbidden. A legal action taken by DH against another entity. Inflow. Claiming damages of 300,000 started in March 28 W8. DH has been advised that it is probable it will win the case. Contingent asset. Option A, disclose by way of notes. No. Either B, C, or D. B, make a provision, no disclosure. No. C, make a provision with a disclosure. Yes. D, make a provision, accrue the income. No. Disclosure means contingent asset. Let's move towards chapter 16. That is about cash flow statement, statement of cash flow. Okay, now we will move towards bigger questions, long questions. Could be on cash flow statement, could be on consolidation. Long question could be on ratios, could be on preparing financial statements, mean profit and loss balance sheet. So let's discuss statement of cash flow. Statement of cash flow. Suppose a business is having a revenue of 100,000. Cost is say 70,000. Profit after tax business is having 30,000. Is that necessary? Business is also having 30,000 cash? No. Why? Why? There could be some sales on credit basis. Business generated 100,000, paid 70,000, profit is 30,000. So whether business will be having same cash balance? No, because some sales are on credit basis that business haven't received yet. So cash balance could be different. If business want to know what is his cash balance. So from profit and loss account, he cannot determine this. For that purpose, they need to prepare cash flow statement. The owner of the business are aware at start of the year, I was having a 20,000 cash. At end of the year, I am having 70,000 cash. This means 50,000 was added during the year. But from where? If you want to know from where I get how much in this 50,000, he will prepare cash flow statement. Because business generate cash through normal business operations. Mean buying, selling of inventory, paying some business expenditure. Business generate cash through non-current assets as well. There is some cash involvement in non-current assets, like you are buying asset, you are selling asset. There is some cash involvement from shares and debt as well. If you issue new shares, you will be having cash. If you take new debt, you will be having cash. If you are paying debt, you are paying cash. To shareholder, you are also paying a dividend. So cash is involved in normal business operation activities as well, in non-current assets, buying and selling as well, and in shares and debts as well. This means owner want to know how much cash paid are generated from these three different types of activities. The activities relating to normal business operations will be called operating activities. The activities relating to buying and selling of non-current assets will be called investing activities. Non-current asset, like you invested in property, plant and equipment, you invested in land, you invested in other companies' shares and so on. In investing activities. And the cash relating to issue of shares, paying a loan, receiving a loan is called financing activities, because these are two sources of finance. Operating, investing, financing. So while preparing cash flow statement, we need to see how much cash received are paid in operating activities, how much cash received are paid in investing activities, and how much cash received are paid in financing activities. There is no other activity in the business where cash is known. There is no other. These are relating to balance sheet, equity and liabilities. This is relating to assets, and this is relating to P&L. So, foolish investor, did they see the statement of cash flow? Yeah, they want to see where cash is involved, where cash is more going out or coming in. At the end of year, he is having 70,000. Mean 50,000 added from where? From business operations, from investing or financing. From where this was generated. If we want to know the detail, we need to prepare cash flow statement. We need to calculate cash flow from operating activities, either positive or negative. Cash flow from investing activities, and cash flow from financing activities. So how to prepare cash flow statement? There is a format that we need to learn. This statement of cash flow. First, we need to calculate cash flow from operating activities. Then we need to calculate cash flow from investing activities. Then we need to calculate cash flow from financing activities. The figure could be either positive or negative. Then we need to add all these three figures. So that will be called a net increase or decrease in cash from these three activities. And this will be a net cash flow from operating activities, net cash flow from investing activities, net cash flow from financing activities, and then what is a net increase or decrease? A plus B plus C. In this, we need to add the opening balance of cash. So we'll be able to find the closing balance of cash. In opening was 20, closing is a 70. So this will be 50. From where we generated how much? This cash flow statement will show out of that 50, how much from operating, how much from financing, how much from investing. Is that fine? This is the format of cash flow statement. First, we need to calculate cash flow from operating activities. Then we need to calculate cash flow from investing activities. Then from financing activities. By adding all these three total, net increase or decrease, in that we need to adjust opening balance of cash. So we will be able to find closing balance of cash. How to calculate cash flow from operating activities? To calculate cash flow from operating activities, first we need to calculate cash generated from operations. And this is the most difficult part in cash flow statement. How to calculate cash generated from operation, we're gonna learn later on. There are certain items that should be added, subtracted. In cash generated from operation, we need to adjust interest paid. Interest paid means how much in cash form we paid the interest, because in cash flow, we record all the items where cash paid are received. Interest expense is different that we charge to profit and loss account, but interest paid is different. Finance cost that we record in financial statement, that could be different than cash paid. Then we need to deduct the tax paid, only cash.
Isn't interest paid government financing because it's related to debt?
Relating to debt, but the payment of interest could be different than what we record in the financial statement.
Yeah, no, why don't you show it as
Suppose the current interest rate for the current year is 600. We paid 300, remaining 300 is what? Payable.
yes.
So what is paid? 300 we will take here because it is cash flow. So we are recording cash entries on it.
I understand that.
Mhm.
Why is it shown in operating? Why not like financing is equity and debt and everything?
Because interest where we record in profit and loss account. Operating means relating to profit and loss account. Operating means relating to profit and loss account. That's why we will adjust interest paid within operating activities. Tax is relating to profit and loss account. In all the activities relating to profit and loss will be recorded under cash flow from operating activities. First, we need to calculate cash generated from operations. From that, we need to deduct interest paid. We need to deduct tax paid. We will arrive at net cash flow from operating activities. You need to memorize this. Grab this, the format. Next, we will move toward cash flow from investing activities. mean relating to purchase, sales of asset. Purchase of property, plant and equipment, whether money coming in or going out. Yeah, out. That's why we are recorded it negative. Proceed of sale of property, plant and equipment coming in positive. Proceed from government grant, positive. Interest received from where? We invested in any bank account extra money against investment. Investment was asset. So that will be positive. Dividend received. We invested in another company investment. So we're receiving dividend, that will be positive. If any investment made during the year, any company, that will be recorded negative. In simple, relating to non-current assets, if we are receiving any money, we are paying any money, that will be recorded here. Outflow negative, inflow positive. Then cash flow from financing activities. If we issue shares during the year, receive cash positive. We received some amount from loan borrowing by issuing bonds, positive. We repay the lease, we repay the loan or bond, negative. And to shareholder, we paid the dividend, that will be negative. But interest payment will not be recorded here, that will be recorded under operating activities. Why? Because the interest expense we record in profit and loss account, and operating activities mean activities relating to profits. So this is the format of cash flow statement. Now we are moving towards the difficult part, how to calculate this cash from operations. Cash from operations. What is the format of cash from operations? This is the format for cash from operations. The cash from operation, we will start from profit before tax figure. If in question there is profit after tax figure given, we need to add back the tax. And then we need to make some adjustments.
You're going to deduct tax revenue from the cash flow.
Profit before tax less tax is equal to profit after tax. If profit after tax figure is given, we need to add tax to move towards profit before tax. Profit before tax is 100. We paid tax how much? Say 30. Profit after tax is 70. If we are having this, how we can get this? This add this. So we need profit before tax rather than after tax. And then we need to make some adjustments. What adjustment we need to make? We need to add back non-cash items. We need to add back non-cash items. What does that mean? We're going to discuss. We need to add back all the expenses or losses relating to investing activities. And we need to deduct incomes relating to investing activities. Meaning profit before tax, we need to make some adjustments. Add back non-cash items instead of items. If we say expenditure, that will be relevant word. Depreciation. is expenditure. Is there any cash involved? This is called non-cash expenditure. Amortization of intangibles, non-cash expenditure. Revaluation loss is also not cash. So we need to add back because this profit is calculated after deducting depreciation, and depreciation is non-cash item. We are preparing cash flow, so those non-cash items that were deducted from the profit should be added because we are moving towards cash-based profit. If there are any losses or expenses relating to investing activities, that those will also be added back. Investing means relating to non-current assets. We sold any non-current assets and suffered a loss. That loss was recorded in P&L. But in cash flow, we need to back. If we dispose of any asset, we generate a gain on sale. That gain was recorded in P&L before calculating this profit before tax. So that should be deducted. That is what income relating to investing activities. What we need to adjust. Finance cost mean interest. We need to add back because we need to take interest paid. After cash from operations, we need to deduct interest paid. So the finance cost that is recorded in profit and loss account to calculate profit, we will mean we need to eliminate its effect because it is not the cash paid. Cash paid could be different. Investment income. Income relating to investing activities relating to asset, we will deduct. Depreciation, non-cash expenditure, add back. Profit or loss on sale of non-current assets. If it is a profit, that is income, we need to deduct. If it is a loss, that is what? Get back. Provision increase or decrease, leave it for a moment. Provision. Government grant amortization. What does that mean? It's not amortization of intangibles. It means transfer to P&L. Transfer to P&L. Mean if we received government grant for next 10 years, we will not record all income. We record as deferred income. And every year we will transfer from deferred income to income mean P&L only part of that year. So that is a transfer to P&L. That is what income relating to government grant. Government grant, what is government grant? Relating to asset. So that we need to what? Deduct. This is not expenditure. This is not amortization like depreciation of intangibles. Government grant amortization mean transferring from deferred income to income. That's it. We need to add back non-cash expenditure like depreciation, amortization. Depreciation or amortization of intangibles. We need to add back expenditure losses relating to investing activities, mean non-current assets. We need to deduct income relating to income relating to Investing activities mean non-current assets. And then we need to adjust working capital changes. What is working capital? Current assets and current liabilities. Current assets and current liabilities other than cash and overdraft. We mainly receivable, payables, and inventory. How we should adjust this? Inventory increase or decrease. Last year inventory was 50, current year inventory is 80. How this has been increased? We purchase some inventory. If we purchase, whether there is an inflow or outflow, outflow. This means inventory increase will be recorded as outflow. If inventory decrease, mean we sold, that will be called inflow, mean positive. This means current asset increase. Current asset increase will be recorded as outflow. Current asset decrease will be recorded as inflow. Receivable is current asset.
Yes.
Increase will be outflow. Negative. How? If receivable increase, this means our cash is stuck with receivable. If receivable decrease, we receive cash from receivable. That's why they have been decreased. So cash is releasing to business, that is inflow. So current asset increase will be outflow, decrease will be inflow. Mean you can say in relation to current asset, there is a reverse relation. Increase negative, reverse, decrease positive. While current liability will be having a direct relation, mean increase will be inflow, decrease will be outflow. Payable decreased. How decreased? We paid the amount. So that will be out. Payable increase. We got benefit from payments. Increase. That will be inflow. Working capital changes. Current assets and current liabilities. In current assets, inverse relation. Increase, deduct outflow, decrease, add inflow. Current liabilities, direct increase, inflow, add, decrease, outflow, deduct. So see this, increase, decrease in inventory, increase, decrease in receivables, increase, decrease in payables, increase, decrease in prepayments. What is prepayments? Prepaid expenditure, current asset. Increase, decrease in accruals, accrued liability. Provision increase, decrease, liability. What is provision? Liability. Increase, direct relation, positive, decrease, outflow, negative. Can you understand this?
Yes.
So instead of writing these three here, we even will write these three here in working capital changes. There will be no issue. So we will start from profit before tax. In that, we need to make some adjustment. Add back non-cash expenditure like depreciation. Add back losses, expenditure relating to non-current assets. Loss on asset. And deduct income from non-current assets. Any investment income, any dividend we are receiving. And then we need to adjust working capital changes, increase, decrease in current assets and current liabilities other than cash and bank, as well as short-term investment. Other than cash, bank, and short-term investment, we also record under current asset. So in working capital changes, we need to take current assets, current liabilities, but from current assets, cash, bank, short-term investment will not be considered as working capital. So through this, we can calculate cash generated from operation, and from this, we need to deduct interest paid, tax paid, net cash flow from operating activities. Then cash flow from financing activities are investing. Then from financing, adding these three, net increase or decrease in cash, adding opening cash balance, we will arrive at closing cash balance. Can you understand? This is the indirect method of cash flow. This is the indirect method of preparing cash. In a direct method, only cash generated from operation formula is different. The cash generated from financing, investing will remain same, but that is not in syllabus of this paper. Direct method was in financial accounting. Here, indirect method. So how to calculate cash flow from a cash generated from operations? Profit before tax, add back depreciation, interest expense, amortization, adjust any gain or loss relating to non-current assets, deduct any income from non-current assets, and then we need to adjust working capital changes, mean increase, decrease in current assets and current liabilities. So we can calculate cash flow, cash generated from operations. And in cash generated from operation, we need to deduct interest paid and tax paid. How we can calculate interest paid and tax paid if it is not given in the question, we gonna learn by opening interest payable account and tax payable account. From the account, we can find the figure for interest paid and tax paid, cash. And then we need to calculate cash flow from investing and cash flow from financing activities. That is easy part. By adding all these three activities cash, we will calculate net increase or decrease in cash. And from net increase or decrease in cash, we need to adjust opening cash and cash equivalents. What does mean by cash equivalents? Cash mean cash. Cash equivalents mean bank plus short-term investment. Minus overdraft. Mean if bank balance is positive, that will be added. If bank balance is negative in overdraft, that will be deducted. Opening cash and cash equivalent mean cash, bank, cash at a bank, and short-term investment if given in the question. That will be called cash equivalent. Mean that can be converted into cash quickly. The receivables or inventory cannot be converted into cash quickly.
They give the data when to make the.
Yeah, they will provide all the data. Yeah. So cash and cash equivalent mean cash on hand balance with bank balance and short-term investment. For last year, for current year, last year mean opening balance. This was the figure. Sorry, this figure, and closing figure, this. Let's move towards a question. can read question before going to break. After break, we will solve. At least we can see what kind of question we can expect on cash flow. This example you will cover by yourself. I'm going to cover this textual understanding.
First page, sir, can you go to first page?
No. We're gonna solve this question.
No, it says.
We're gonna solve this question. If we have solved this question, cash flow done. Okay, this is the data given for 30th September 20x2 and 30th September 20x3. In thousands figures are given. Non-current assets, we are having property, plant and equipment figure. Previous year, current year. For current year, this is opening balance, this is closing balance. Inventory. Increase or decrease? Decrease. How much? 40. Inflow. Decrease in current asset, inverse. Add. Receivable, increase, deduct. Interest receivable, but this is not working capital. Investment, where it is written under non-current assets or current assets? Current asset, heading C.
Short term.
This is short-term investment. Cash at bank, cash in hand mean all these three are what? Cash equivalent. Cash and cash equivalent. So we are having total assets figure. Then if we move, there is data for ordinary shares. 300,000 balance previous year, 363,000 balance current year mean there is issue of shares. Share premium account reduced. How? How share premium account can be reduced? Issue bonus, yes. Revaluation surplus mean asset has been revalued. Retained earning last year 70,000 loss, current year 63,000 profit. 10% loan note, current year zero figure. What does that mean? We paid. 5% loan notes reduced by 20,000. We paid. Here it will be recorded under financing, investing, or operating. All these are relating to financing activities. Bank overdraft in previous year we were having this mean in opening cash and cash equivalent 70. Overdraft negative figure will be adjusted. Trade payables increase, working capital, income tax payable opening closing balance. From this we will open tax payable account and will calculate tax paid. Not could be different. How we will see. Accruals, opening closing balance. Statement profit and loss data, revenue, cost of sale, GP, admin expense, distribution expense, profit from operations, income from investment. Income from investing activities. Finance cost are just profit before tax, taxation, charge to P&L, profit for the year, profit before tax or after tax. We need what? Before tax. And then other comprehensive income, gain on property revaluation mean revaluation of property. And then there is some other additional information, and they have asked to prepare a statement of cash flow for the year ended 30th September 20x3 and an analysis of cash and cash equivalent. Let's take a break for 15 minutes. After break, we will cover this question.
Can you make first page where we do volume release
Yeah,
that operating
the format
activity out from
cash generated from operations or cash flow statement.
operating at
Operating activities
yeah generate from
cash generated from operations.
yes.
They would have this straight. This is popular there.
Current substance university for our activities on the bottom. In that corner, watch it on corner. Increase and decrease in current as well as reversible, right? Mm-hmm. Oh, this side. Yeah. Yeah. Current liabilities is what? If it's increased, then you have to add. If it's decreased, then you improve. Yeah. But the thing is written with smaller. Wow. There it is written reversal. It's for current liabilities. It's just without something. It should be reversal. Because the there is increase, so we are determining it, right? Current liability. Yes, that we have to add. I get that. My question is, come this one, come difference. You're talking about this, right? Yes. So, see, you added this one as well, right? Yeah, that I got. Here, sir said if there is current asset increase. Current asset? Yeah. Oh, yeah, yeah. No problem. Quick it again. Just grab it again. Just that somewhere else, tap somewhere else. Yeah. So I'm saying, yeah, current asset increase, so we deduct, and current asset decrease, we add. So that means it's a reversal. Yeah, correct? Liability. Increase, we add, decrease, we deduct. But the thing is, what is written in that column? This one? Yeah. This one is reversal. Yeah. And answer would be the direct. Sure. Yeah, direct. Say increase we always so decrease we always decrease. So that's so much stuff. Oh, yeah. I was like, what are you telling? Let me get some hot water. We haven't gotten that.
Yes, more. Except like the last 4 laps.
Yeah. Maybe something that I see.
You watch the highlights?
Yeah.
You like it?
You see the last one laps.
Mm.
The shades.
If you had 2 more laps, you would have won.
No, yeah.
Yeah, I mean,
He didn't change, like, he got the gap down very nice.
yeah, because the tires wasn't as bad or it was low. One, practice was one,
Yeah.
snooze fest.
When's the next race?
2 weeks. Let me check.
Uh,
Oh, 2 days.
2 days.
Yeah, one of you. Yeah, one of you. It's a big race. It's mine.
Yeah, yeah. It's the street circuit, right? Last place with the flowers
Yeah.
right next to that. I just got. I just took from the. Okay.
I see. It's
It's in this party. It's like see, biscuits and drinks and stuff. It's in the grocery. It's not a restaurant.
okay.
There's this Pizza Hut.
Yeah.
It's just a party.
Yeah, last section supermarkets have toy things.
Which one?
All supermarkets, there's which is like, yeah.
Some of them are very frozen.
Yeah, that's true, yeah. But I'm not buying that for something.
Or you can even check noodles. You give it
Yeah, but they are very charged.
create new accounts every time. They give you free delivery, create new accounts.
Where?
That's what I do. I have like I delete my account, create a new account. You get free delivery on $2. And the thing is, they give like new joiners discounts, in like offer plus free is a free.
Right.
I do this shit a lot. Like, I put I have like 6 accounts or something. It's like when they like did something, they blocked all orders that came in. They were started checking credit card numbers, so it doesn't work on delivery. Loan works.
Yeah, that's a nice thing. I have several accounts out there. You have four, okay? You have four email addresses.
So let's move towards solving this question. Where was question? So we need to prepare cash flow statement. So data we are having for 20x2, 20x3, property, plant and equipment, current assets, share capital, share premium, revaluation, retained earnings, non-current liabilities, loan note, 10%, 5%, bank overdraft, payable, income tax, payable, accruals, mean accrued expense. Profit and loss account data. In profit and loss, we are having income from investment, finance cost, profit before tax, tax charge during the year. The comprehensive income, we are having revaluation. And then some additional information 1 to 7.
Yes.
Before moving, first we should prepare format of cash flow statement. Company name, cash flow statement, year end. In exam paper, if there is question to prepare cash flow statement, you need to prepare in Excel sheet. But I suggest before preparing in Excel sheet, try to prepare cash flow statement on paper.
Mhm.
Then just copy paste into Excel sheet. For working, you can open Excel sheet, but don't start preparing cash flow on the Excel. Because there could be some adjustment, might be you will forget something, there could be total issues. So to correcting afterward in Excel sheet, it will require more time. To try to prepare cash flow statement on a paper and then just copy paste into the Excel sheet. So cash flow statement, first we need to start from where? Cash flow from operating activities, yes. So here we can put a column. We will put figure. in thousand. So leave some space and then put a heading cash flow from investing activities. Leave some space, put a heading cash flow from financing activities. Normally, 3 to 4 lines are enough for financing and investing, but for operating, we need at least 10, 12 lines. So then we will able to calculate net increase or decrease in cash, and then opening cash and cash equivalent. Then closing cash and cash equivalent. Okay, let's move towards adjustments. So first, additional information. On 1st October 20x2, year end is what? 30th September 20x3. In start of the year. On 1st October 20x2, Hollywood issued 60,000 50-cent ordinary shares at a premium of 100%. They issued 60,000 50-cent ordinary shares at a premium of 100,000. Mean share issue. So we'll put working one. How many shares they have issued? 60,000 shares they have issued, and the price per share is 0.5 cents at a premium of 100%. Mean premium will also be 0.5. Mean 0.5 plus 0.5. So we can calculate the amount. Amount will be 65. Is that? The proceeds were used to finance the purchase and cancellation of all the 10% loan notes. In whatever the amount they received, through that they paid all the 10% loan notes, all the 10% loan notes. That's why it becomes 0.
Okay.
And some of the 5% loan notes, that's why it is reduced by 20. This means we paid the 10% loan note. How much? 40,000. Can we record this? Where? Repayment of 10% loan note. How much? Outflow, inflow. And sum of 25% loan note. Repayment of 5% loan note. This means this we have done. Is that? First, we need to cover all the adjustments. So 60,000, they issued new shares. A bonus issue of 1 for 10 shares held was made on 1st November 20x2. And then bonus issue was there of how much? 1 for 10.
There's no cash.
There is no cash involved. So we can ignore this. All shares in issue qualified for the bonus. If we see share capital, 300 move towards 363. From 300, it moved toward 363. We need to see whether there is all share issued relating to this. Or there is some other issue as well. How we can see that? At start of the year, how many shares company are having? No. This is share capital amount.
600.
So opening shares were 300,000 divided by 0.5. 600,000. They issued 60,000. That become 660,000. Then they issued bonus. How much? 1 for 10. This means 660,000 multiplied by 1 by 10. How much? 66,000. At year end, the total shares become 726,000 shares multiplied by 0.5 cent. What is the share capital amount? 363,000. This means the all shares issued are relating to this. All shares issued relating to this. And if you see the difference between share premium account, how much it's reduced? 92 to 89. 3,000.
Yeah, 8,000.
That is due to this.
Yes.
So how much we will record in cash flow relating to issue of shares? From 300, it become what? 363. So we'll record issue of shares with how much? 63. 63. Positive or negative? Positive or negative?
Please.
Why positive?
You're getting the money.
You are getting the money. Simple. So this means this number 1 done. Mean we perform the check. The difference is due to this only. And we got some information relating to loan notes payable. So we recorded those things. Number 2, the current asset investment. The current asset investment. Mean if there is any investment in current asset, they are talking about this. The current asset investment was a 30-day government bond. Mean this investment is up for 30 days, mean 1 month, mean this is a short term. Even if they don't say this, we will treat it as cash equivalent. But they have highlighted this is what? Cash equivalent. Government bond. Government bond mean that you can convert into cash anytime in the market. Mean this is like cash. So this means from here we can calculate cash and cash equivalent. Opening and closing. Mean 20x2 and 20x3 opening and closing. What does it include? It include cash in hand, cash at bank, investment. But there was some overdraft as well. Yes. So it comprises four things: cash, bank, investment, and bank overdraft. What was their opening balances? Bank overdraft we saw previous year was 70 negative. And in previous year, cash was 5, no bank, no investment. Altogether, 65 negative. And what is the closing? We are having a cash 7, bank 75, investment 50. 775 and 50. No overdraft for current year because we are having positive cash balance. How much is altogether? How much is altogether? 132. So we can put this 65 opening balance negative. And this could be 130.
Once again, can you repeat for shells? 63.
The increase in share 300 to 363. How it becomes?
If you only
It's relating to shares only.
you only 60,000.
How much amount change? 63. How much amount change? This is amount. And we saw all is relating to that issue. There is no other issue during the year. Okay. Next, number 3. Property, plant and equipment include certain properties which were revalued in the year. And we saw there was revaluation gain of 50. There was revaluation gain of 50. So property, plant and equipment was revalued during the year by 30. That's why there is an increase in property, plant and equipment. Where? Here. From 510, they move towards 634. And there is some other information as well. Property, plant and equipment disposed of in the year had a carrying amount of 75,000. Cash received on disposal was 98,000. Now we need to open working 3. Where we will open a account for property, plant and equipment. And if there is disposal, we need to open account for disposal. Property, plant and equipment brought down balance, carry down balance we are having in the question. How much? 510 and 634. There was a revaluation of how much? 50. Where? We saw here. So revaluation gain of 50. What else information we are having? We disposed of one of the property plant whose carrying value is a 75. So we record to disposal that 75 and we transferred here disposal will become debit against property, plant and equipment with 75. And we receive cash of 98,000, cash debit disposal credit. This cash we received by selling the asset. By selling the asset.
Yes.
Is that?
Proceed.
And there is no information for depreciation. There is no information for cumulative depreciation. No, oh, no. There is information.
Proceeding.
Depreciation charged for the year was 87,000. So that should be recorded here. How much? 87. And should be added back as well. Where? In profit before tax. Are we having profit before tax figure? How much is profit before tax? 290. In that, we need to add back depreciation. How much? 98? 87. Add. So move towards accounts. From this 98, how much is the difference? 23, what is that? Gain on property disposal. That is charged to where P&L mean P&L credit disposal account debit in P&L. What is credit, income or expense? Income. What is income gain? That we need to adjust. Deduct income relating to investing activities. Where? Operating activities. So adjust this. What that? Gain on property, plant and equipment from our working number 3. How much?
20.
Deduct.
Yes.
What else? If we end up with this property, plant and equipment account, what figure you are getting? Can you make a total, please? And see what figure you are getting from here.
It's balancing figure to 37.
236. What is that? What is that 236? This is addition. How we added property, plant and equipment? Purchase. This means we paid money for this. Where we should record this? Financing activities. Purchase of property, plant and equipment from working 3. How much? 236. Inflow, outflow. Is the correct place or wrong?
It's very interesting.
Yeah, it should be in investing. Purchase of property, plant and equipment 236 outflow. From working. So that examiner should know from where you are picking this figure. So we recorded this cash, we recorded this gain, we recorded this depreciation, and we recorded this addition. Yes. There are marks, separate marks for working. Give me 2 minutes, please.
So, and then part of used to do working. He was writing working, you know, he makes some shun, he gets to the person, he would have it was writing, once like. So I used to go to I don't know this is really. I think yeah, he's really like this. Classes. Should give him this to
So working is necessary. There are separate marks for working. Okay, so we done with number 3, number 4, number 5.
Yes.
You need to show on Excel.
Yeah.
Like the ledger accounts.
Separate. Or even you can show positive, negative, add this, deduct this, like that. So number 6, the accrual balance. Is there any accrual? Yes, 33 positive opening and 36 closing. Okay. The accrual balance include interest payable 33,000. At 30th September 20x2, mean whatever is the opening balance 33, that is relating to interest payable. That is relating to interest payable. And 6,000 at 30th September 20x3 mean interest payable closing balance is what? 6,000. This means from this we can open working 4. Through this we have information about interest payable. Is that liability, income, expense, liability? So opening balance always on credit side, closing balance on debit side, and opening balance is what? 33, closing balance is what? 6. This means the opening accrual itself other than interest is 0. The closing accrual is what? If from closing, how much is closing total? 36. From this, if we deduct 6, what is remaining? 30. This means this moved from 0 to 30. There is increase in accrual by 30. That we will adjust under working capital changes. Prepayments, receivables, inventory, payable, working capital changes. But from here, we can open this interest expense account to know what is cash paid for interest paid that we need to deduct from cash from operations. So is there any finance cost available in P&L? Yes, 19. This 19 we need to add back here as well. How much? 19. And this 19 we will record here on debit side or credit side. In P&L, it is recorded as expense. What expense, debit or credit? Debit. So here we will record in P&L, we have charge 19. The remaining balance 19 plus 33 is a 52. is 52. By deducting 6, we will arrive at 46. That is what? Cash paid. Interest paid. Interest, debit, cash, credit. That's why it's on debit side. Because cash paid. Meaning cash account, it will be on credit side. Does it make sense?
Yes.
So 46 interest paid, where we should record? Here, cash flow, cash generated from operations. In here, we can put a heading. Cash generated from operations. And from that, we will deduct what? Interest paid, that is what? 46. Is that? From where we got this figure? Working force. Okay, let's move forward. 6 is also done. 7, interim dividend paid during the year was 53,000. Dividend paid during the year was 53,000. Dividend paid during the year was 53,000. From where we pay dividend? From where company pay dividend? Retainer. And we are having retained earning opening closing balance as well. So we need to see whether there is any final dividend or only this dividend company paid. Let's see. Let's open retained earning account. Here I'm going to open retained earning account. Retained earning. Normal situation is that on credit side we record opening balance, credit side, debit side we record closing balance. The profit for the year we add to where? Retained earning. Mean here we will record the profit after tax that we transfer to retained earning, accumulated profit, and from this we pay dividend. Mean dividend will be recorded here. That is what? 53,000. Interim. What is the retained earning balance is given? Is 70 negative? This means this is debit balance. This will be recorded on debit side instead of credit side. And this will also be closing balance recorded on debit side. So we will record balance brought down here. 70 negative. And what is balance carried down? 63. What is the profit after tax? What is the profit after for the year? 186. So 63 and 186. So this is 63. This is what? 186. Can you find any balancing figure?
Exactly same.
Exactly same. This means there is no other dividend. Only this dividend paid during the year. So that we should record where? Dividend paid mean cash. Where we should record this? Financing, investing, or operating? Dividend payment. How much? 53. Outflow. Outflow. Okay. Let's move forward. So all adjustment is done. Now we will move from here onward. PPE we have done. Inventory receivable, interest receivable. Interest receivable. There is income from investment as well. I mean, company made some investment against which there is interest receivable and against which they have received this income. This means from this we can identify some investment. So we should open account of interest receivable. Interest receivable. Asset brought down balance will be here, carried down balance will be here. What is the balance? Brought down balance is what? 9. Carried down is 4. So brought down is a 9, carried down is a 4. And there is a 5 income recorded as well. So 5 income recorded. This means P&L credit. This account will become debit. This account will become debit against interest income in P&L. This will become 14. This will become 14. What is this? Cash period. In company made a investment of that, where it should be recorded. Where it should be recorded. Is the cash receiving or going? In P&L, we don't record cash, we record income. This means actually we received cash debit, investment or interest receivable relating to investment is credit. Means this is mainly investment account. So cash debit. This means what is this? Interest received income in cash. Though in P&L it is recorded 5. In P&L it is recorded 5, but actually what we received 10. So this is relating to what? Cash, and we received relating to what? Financing activities. Interest income received in cash, how much? 10. And that 5 is what? Income relating to financing activities should be deducted. How much? Can you understand this? And there was interest receivable. And there was income also recorded in P&L. So we open the account, receivable opening closing. This income recorded in P&L income credit recorded, expenses debit recorded. This means P&L credit, this account will be debit against it. So by balancing, we found 10. What is that? Cash received against this income. Cash received against this income. That we need to record under investing activities. What else we left with? We left with now only working capital changes. Is there anything else? Share premium, revaluation surplus, retained earning, loan note we have already recorded. We left with the income tax as well. Opening balance, closing balance. From this, we can calculate tax paid. So working 6 tax. So we open our tax payable account. Opening balance on credit side, closing balance on debit side, and we are having opening balance of what? 90 and 100 closing. So 90 opening balance, 100 closing balance, and we charge to P&L some amount of tax. How much? 104. If we tally this account, we can find the cash figure.
94.
That is what 194. That is 194. So 94 is the cash figure. Tax paid. Where it should be recorded? Tax paid from working 694. So in profit before tax, we have adjusted the depreciation, we have adjusted the gain from property, plant and equipment 23, we have adjusted the finance cost. We have adjusted the interest income of a 5 negative. Now we can move towards working capital adjustment. Working capital is relating to, we are having inventory, we are having a receivable, we are having a payable, we are having accruals. If we see inventory, so in inventory decrease by 40. Decrease should be added. Inverse. Where? So inventory 40 decreased. So we will add 40. Relating to receivable, 70 increase negative. Relating to payables, 150 increase direct positive. Against accruals, 30 increase.
Yes.
Can you calculate cash generated from operations for me, please? Five
18.
18, 518. If we deduct this, we can find net
46.
cash from operating activities.
378.
That is A. How much?
378.
378.
It's 94, right?
Yeah, 94, 46 and 94. Now, if we can move towards
Negations.
sales of property, plant and equipment, have we recorded cash received from property, plant and equipment? There was some cash received as well. How much?
19.
98. So adjust this cash received from sale of property, plant equipment. That was also from working 3, how much? 98 positive. So net cash flows from investing activities. That is B. How much is that?
140 negative.
130 negative.
And
Sorry, this is 98, not 96.
here exactly.
236.
Yeah. Round.
How much?
120.
128
Negative.
negative. And now see net cash from financing activities. How much is that?
50 negative. 50 negative.
50 negative. Now can you check A, B, and C total? 200 positive. Then how it will become 132?
We 78.
Issue of shares, we recorded 63.
Mhm.
Where is working?
This one for a
There is 63 change. How many shares we have issued?
3,000.
This means this 60 change is due to cash and the other 3 change is due to bonus.
Transfer from retained earnings.
Because we issued through cash mean how much cash we received, that is 60. So instead of 63, if we charge 60 here, can you see what's the balance now? That will become 53 negative or 47 negative.
negative.
Now if you see 278, 378 minus 128 minus 53, 190. Now if you see by deducting 65,
Yeah.
132. This means in share issue, there was cash we need to take, not the total change in share issue, because there was bonus issue involved in total change. So let's move towards some more questions. Some questions from Kaplan Kid. 216. The following information is available for the property, plant and equipment of Fry as at 30th September 20x3 and 20x4. Carrying amount of asset is given, opening, closing. What they ask, what amount would be shown in a statement of cash flow for purchase of property, plant and equipment for the year ended 30th September 20x4? Can you try this? Open property, plant and equipment account, put the opening balance, closing balance, adjust the four adjustment, and find the addition that we just did in previous question. Is that? What's the balancing figure?
The patient can have debit balance open.
Oh, sorry. I did something wrong here. $14, 400, $23, 400. Now see, what's the balancing figure? $8,000. This is they are asking about addition. Figures are in thousand. Is that? This is opening balance brought down. This is carried down. This is depreciation. This is disposal. This is a revaluation. This is a provision that we studied in previous class. Environmental provision should be added to the asset. Next question, please. How much interest paid that we need to record in the cash flow? On 1st October 20X4, start of the year, had accrued interest payable. Interest payable, brought down, carried down, P&L figure, cash. Opening figure is what? 12,000. During the year ended 30th September, BK charged finance cost of 41,000. Statement of profit, so including unwinding a discount relating to provision stated at its present value of 150. But unwinding of discount should be calculated using the interest rate. That should be charged to provision. In this 41, that provision is also included, that is relating to provision. This means that we need to deduct from this. So we can deduct by adapting it. That is what 150,000. Is there any interest rate given? How much is that? 9,000. Is there any closing figure given? 15,000. So what's the cash figure? 29,000.
Yes.
Is there any option?
Yes.
So that unwinding interest is relating to liability separate provision, not relating to this interest payable. Deduct 9,000 from this and with the remaining P&L recorded. That is relating to interest payable, not relating to provision interest. And we create provision and we add interest every year. 218. The amount of tax paid. And you need to open tax payable account now. And both deferred tax and current tax brought down balance here and carry down balance here. What are the brought down balance? 27 and 106. What are the carry down balance? 38 and 119. Extract from statement profit or loss for the year ending 31st December. Income tax expense to P&L they charge 122. So balancing figure is cash. How much is that? 98,
Yes. Yes.
98,000. Is that? 219, which item would be not be shown in a statement of cash flow using the indirect method? Cash paid to employees. Have we studied it anywhere? No. Cash paid to purchase machinery relating to investing. Cash paid to shareholder as dividend relating to financing. Cash paid to redeem loan notes, that is also relating to financing. What is cash paid to employees? 220 IAS 7 statement of cash flow set out three main headings. Which two of the items below would be included under the heading cash flow from operating activities? Tax paid, purchase of investment, purchase of investment, cash paid for investment. What is investment? Investing activities. Loss on disposal of machinery, operating. Purchase of equipment, investing. 221, during the year to 31st July 2007, Smarty Pants made a profit of 37,500. After accounting for depreciation of 2,500 that need to add back. What you need to do? What was the increase in cash and bank balance during the year? So 37,500, we need to add back 2,500 depreciation. During the year, non-current assets were purchased for 16,000. So 16,000 deduct. Receivable increase by 2,000. What to do with it? Add or subtract? Inverse relation, current asset. Inventory decreased by 3,600. Add. Trade payable increased by 700. Add, because they are having direct relation. Can you calculate the figure for me, please? 26.
Yeah. 300.
Option is that you're applying your whole knowledge through this short 2 marks question. 222. Identify the correct treatment in the calculation of net cash flow from operating activities under the indirect method. Either they should be added back or deducted. Non-cash expenditure, losses relating to non-current assets should be added back. Income relating to non-current assets should be deducted. Decrease in trade receivable, added. Inverse relation. Increase in inventory, profit on sale of non-current asset, income relating to non-current assets deducted, losses relating to non-current assets added, depreciation. 223. How much will appear in statement of cash flow for the year ended 30th June 2021 under the heading cash flow from financing activities? Share capital increase by 20,000. Share premium increase by 10,000. And debentures
Decrease by
10,000. Here, what we will put 10,000 or 10, because 000 they have already mentioned. And these figures are complete, not in thousands. 224. How much will be reported in statement of cash flow for the year ended 31st December under the heading cash flow from investing activities? Good luck, everybody.
Use for it. You will come up with it.
No,
No,
there is no information.
10%.
Yeah, 10%, but when you bought this, when you paid this interest, monthly proportion.
Oh,
So question 224, good luck everybody, please. Cash flow from investing activities. On 1st January 20X0, property, plant and equipment with carrying amount of this opening balance. 180. In the year ended 31st December, dispose of asset with a carrying amount of 60 for 50,000. So disposal charge 60. Revalue building to 75 to 100 mean there is 25 revaluation surplus. Depreciation charge is 20. At the end, they are having 250 balance. So we can find the addition. What is that? 125. What's the option? No. No. What they have asked? They haven't asked what is added to property, plant and equipment.
or investing.
They are asking about cash flow from investing activities. So
Okay.
purchase of PPE, that is 125 negative, and sale of PPE, you got cash of 50.
Oh,
Cash flow from investing activities. Purchase, sale, both. 25. Select the two amounts to be included in statement of cash flow for the company. On 1st January 20X0, company had government grant held in a deferred income 900,000. Deferred income relating to grant. Deferred income is what? Liability. So 900,000 is the opening balance. During the year, they released 100,000 to statement of profit or loss, that is called government grant amortization. So P&L they charge 100,000. At 31st December 20x0, the remaining deferred income balance is 1100. What is this? Receipt for new job. Select two amounts to be included in statement of cash flow. Amortization of government grant. 100,000 increase or decrease. Expenses we add back. Income we deduct. In our format, that figure was in bracket. And receipt of grant, cash received from grant 300 in investing activities. Cash received from grant 100,000 in investing activities. Is that?
Yes.
There are some MCQs from BPPK 293 till 297, only 4 MCQs. That's your homework. 293 to 297. We'll see you tomorrow, 5:30 to 9 o'clock. What's the day tomorrow? Thursday. Try to cover the question we have covered on cash flow. And before this question, there is an example. Try to cover that also.
Yeah.
That example will take your 1.5 hours at least. But if you cover now by using 1.5 hours, if similar question appear in the exam, you will be able to cover it in 40 minutes. But if you don't practice, you will waste time in the exam.